This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. This is the Definitely Uncertain podcast, and my name is Darren Rockman, and I'm a partner at Gold Rock, the 25-year-old multifamily office servicing high net worth families in Israel and around the world. And I am wishing a good morning to Rob Rackind. Hey, Rob, how are you?
I'm very well, thank you. Thank you for having me. My first podcast ever. How are you?
Well, there you go, and I'm sure not your last.
Hopefully.
Rob is a seasoned real estate investor and a global strategist with over 30 years of international real estate experience, development, asset management, and private equity and funds management. He was the global head of real estate at Credit Suisse and was the global head and founding partner of the real estate platform at EQT, which is a large and leading private equity firm. He's built multi-billion-dollar real estate platforms across the world, Europe, Asia, and North America. Since stepping down from his corporate career, he's been managing his own family office and investing in non-traditional real estate sectors. He's the non-executive chairman of a real estate bridge loan lending business in the UK called Inhale Capital, sits on the board of Aram, and is also chairman of FACII, which is a NASDAQ-listed sector agnostic SPAC. Rob also recently moved to Israel and away from work is helping the UJA by sitting on their investment committee and a part of their social impact fund called SI3. And with that very long and rich career behind you, we wanted Rob to come on and talk to us about what's going on in global real estate. We are now a number of years after the big spike in interest rates, and we're starting to see the market come back to some form of new normal. So let's start with the following. Your career spans several prominent real estate firms. In general, if you had to say the big insight, the big thing you learned across your career over the past few decades, what would that be?
The very big one, I would say, is local with locals. You have to be local to really understand real estate, to understand local pitch, the local players, the local market, and the local building. It's gotten easier over the years because there is a lot more access to data, and with that greater transparency. And I used to work for Hines, the US real estate group, and I was fortunate enough to work with Jerry Hines individually. And he always used to say that, transparency is the holy grail, which is true if you're a cross-border investor, you need transparency. The problem with transparency is the market becomes more perfect and it becomes harder to make outsized returns. So it's sort of it's a catch-22. You want the data to be better informed, but if you're better informed, so is everybody else, and it's harder to make money, which is where...
You want to be the only one with the data.
Yeah, exactly, which is where being local really matters, because you have access to that non-transparent, that opaque data, which nobody else has. So I think the number one is get on your bike, put your hiking boots on, walk the streets, and really understand being local. And I think if you look back, what's the film, The Big Short, where they all hopped on a plane and flew down to Florida to see all those vacant houses. That's it. That's the only way you get to know a market. I think the other interesting thing is now capital is so transitory and it's footloose and moves markets like it never has done before, because it's no longer just domestic. You have huge movements of global capital. So again, you've just got to have your wits about you, because those markets can move not within days or week, or used to be 6 months, a year. It's now days and weeks. And I think the third thing, when I look back, I think what is really important, in the old days, it was you had an office building, you had a shopping centre, Family housing was important, but no one really thought about it. A lot of the pension funds, particularly in Europe, sold all of their residential because it was yielding 3%, 4%, inflation and interest rates were at 6%. Big mistake on their part. So now, really, more than ever, you have to understand occupier and demographic trends. And that whole COVID period and that massive spike in interest and inflation has just condensed occupier trends. What was a 20-year trend into 3 years, and we're still dealing with that through so many sectors, predominantly office, but so many. So it's become, I would say, it's never been so difficult to be a real estate investor as it is today.
Interesting. Maybe as an example, talk to us about a deal that was particularly challenging, because you've talked a lot about identifying, but once you're in a deal, sometimes things get nasty, hairy, problematic. So maybe talk to us through one and how you as an investor, as a global investor, dealt with that.
So I think I've only done one real estate deal since the crisis started in 21, 22, because I just didn't have conviction. And ultimately, you really need conviction when you're deploying capital. But the one deal I had conviction in was the Diplomat Hotel, which a lot of your American clients will know very well, Hollywood Beach, Florida.
Yep.
Single largest asset transaction I've ever done. It was a 1,000-bed hotel, 200,000 square feet convention center, 10 acres on the beach. No pathway in front, crossing over the interstate road, whatever, on the beach. And from my perspective, I was working at Credit Suisse, which was complicated because it's the bank, it's an investment manager, Credit Suisse Asset Management. Listed vehicles, close-ended vehicles, high net worth capital. But as much of that, it was the managing up as it was as the managing down, because it was politics. Because this was a high-profile transaction, $830 million. I actually find bigger transactions easier to do than smaller transactions because you're taking more of a macro analysis and you're using the biggest and the best professionals. But we had to deal with ESG because, of course, it's Florida, hurricanes, rising seawater. We had to deal with educating risk committees because Credit Suisse had gone through some very bad times. This was being taken over by UBS. Yep. And now they had a core risk department managing value add risk investments. So trying to apply Germanic core principles on a US operating hotel value add transaction. And then it was the capital stack. And look, you've been around a bit as well. You understand getting that capital stack right. But again, I was dealing with Swiss core fund managers who didn't understand how to structure a capital stack. So here I was buying a renovated hotel. Brookfield has spent $90 million on renovating the 1,000 rooms. It was Florida, ESG, hurricane, rising sea temperatures, with letters being written to the chairman of the bank, Axel Lehman, who I was having to speak to personally. Insurance. When do you buy insurance? Capacity. I've never dealt with that before. Typically, you go to the insurance market and you place it.
Right.
But given
$800 million is big for an insurance company.
Yeah, exactly. But we're talking about a $14 million insurance bill, which we had underwritten at the previous year at $9 million. And if we'd waited 2 months to close back at the beginning of the year, it would have dropped down again. I'd never come across that before. So it was all of these things. And then came to the capital stack, we had a global core plus listed vehicle. Right, guys, you need income. Let's put you in at a fixed 9% pref. I had a close-ended value add fund, which this was. Let's put you in at a 20 IRR. This is a 20 IRR deal.
Right.
You come in for a piece of the pie. And then it is a perfect transaction for ultra high net worth capital. Let's syndicate it out into the private bank.
Right.
Oh my God, the politics of the private bank and what goes on there. So long story short, you were dealing with all of these moving parts, but at the same time, I was having to educate an institution how to do a large value add transaction when I had core plus investment managers.
Interesting. Very interesting. Wow.
Great deal.
Okay.
And it's performed. Great deal.
Well, fantastic.
Well,
excellent.
I'll say that. Once they exit, we'll know if it's really performed.
Right. Exactly. You can't, as they say in Hebrew, you count the cash in the stairwell.
But there you go. Well, they tried to in Israeli towers, but yeah.
Okay. So let's now move away from that specific deal and let's talk more broadly. In the current higher interest rate environment, which has come down obviously, but still higher than we had experienced for most of the past 15 years. What real estate sectors and what geographies are you seeing offer the best risk-adjusted return for that high net worth and ultra high net worth investor that you were talking about before?
Oh, the globe, to say this, it's a big globe. Look, leverage generally is still constrained for real estate. You've got lower LTV, CMBS is scarce, and construction finance is particularly constrained. So I personally, on a risk-adjusted basis, I love real estate debt. Just be careful with construction debt. And why do I say that? Because if you're doing equity, you're looking for 15, 20 IRR, double your equity, 2 multiple when you're doing development. Well, if you can get a 12, à peu près, as they say in French, a 12 IRR sitting at a 60 LTV with all the equity up front, construction guarantees, 12 to 15, let's say, you're getting equity return in a secure first charge position. Love it to bits. Right. I do bridge lending in the UK, short-term real estate. I don't know what they call it in the States, but we call it bridge lending in the UK.
Call it the same, yeah.
Yeah, I'm getting 10% paid coupon, 10 to 12 paid, or we withhold the interest and we sit at a 50 to 60 LTV. Well, you've got to do a lot of work to get those types of returns in equity investing. I think when it comes to deploying capital directly into real estate, demographics, Asia, amazing. But you have lack of liquidity, lack of transparency. You don't particularly have the rule of law. Even if you think you've got the rule of law, like in Japan and Korea, if you have a problem, you as a foreign national trying to litigate, you're going to have problems. So basically, you can go to Australia, where they do have democratic rule of law. So, but it's how do you manage direct real estate when you're the other side of the world? So for me, it sort of narrows the investment world to Europe and North America. Well,
where the demographics are not great, to say the least.
Correct. But we are in a situation where limited supply, super limited supply, particularly in Europe. Construction is almost non-existent for prime CBD. So I would say I love European core plus offices. Why? Because there's a flight to quality. You've got strong rental growth. Your yields on a relative basis are pretty high on the way in. And base rates are now down at 2%. So you've now once again got positive cash on cash,
Right.
which you didn't have for a while. And bizarrely, because of COVID, we've moved away from occupier density getting smaller and smaller, like 1 to 8 square meter, one person per 8 square meters, one person per 7, one per 6. Office buildings are now going amenity heavy because they're trying to attract the best talent, and it's now increasing again. So there's not enough office, prime grade A office space in Europe to satisfy that demand. So I like European Core Plus. I think logistics is overpurchased. Data centers are amazing, but you need to have billions and trillions of capital to be able to deploy expertise at the wazoo. And energy is now a big problem. The actual networks cannot cope with energy demands. So you've got to be, you might have a great site, but if you can't get energy there,
if you can't get power there, you're in trouble.
Yeah. And then beds. We go back to COVID, and it's not forgotten COVID. Granular income. It's inflation proof because it's constantly renewing. So hotels, co-living, build to rent, multifamily, single family. It's difficult to get it to work on an in yield basis, but you do provide that hedge against inflation. So I would say blending a portfolio of beds, and I use that definition broadly. I quite like the hospitality sector myself, or parts of it, with some prime CBD offices and with debt where you can get paid current. I think you'd have a very nice portfolio. North America is still working through a lot of the overhang of leverage.
Right.
19, 20, 21 5-year debts now coming up to repayment. And a lot of that multifamily, which was heavily bought, is suffering from huge increases in operating costs because of inflation.
Right.
So the market's stabilizing.
Okay. So if we just go back to European office for a second, so two questions there. The first is, what are the types of yields that investors are getting from those deals, and where's the upside?
So a couple of things. Yields. City of London, 5.75% for the very best office building.
Okay.
At one point, it was down at 4, as an example. Rents for prime city offices are now up at £100 per square foot per annum. Used to be at 50, 55. If you go to Europe, let's talk Paris, yields are lower, 5, but base rates now down at 2. Rents in Europe tend to be index linked rather than open market review that you have in the UK. But you've got inflation at 2-3%, which is why I say don't go for pure core, 100% fully leased long term, because you won't capture that supply demand imbalance. And because there has been such limited supply coming through, rents for the very best space are going north. And so if you can buy a prime office building in the city for a 6+ yield, you get a lease expiry or a rent review, or you've got some vacant space, you'll be able to drive the rents up. You can get 60-65% leverage. You'll have positive cash flow. And then as and when interest rates do come down, if they come down, you're not reliant on that interest rate compression to get cap rate compression.
Yeah, got it. Okay. Now, the AI trend, which is we're now a couple of years into sort of global adoption. When you listen to the people, the techies talking about what this does for office workers, white collar workers, it's full of doom and gloom. And I'd like to hear your view on how that impacts the market for office real estate.
I'm pausing because we could have a 5-hour conversation on AI and the
Well,
impact.
let's try and get it done in 4 hours then.
Yeah, in 4 hours. Look,
this is a half-hour podcast, Rob. You know, we're
yeah,
going to have
yeah.
to.
So, look, I actually disagree that AI is having an immediate impact in the sense that this is a big topic. Is AI going to lead to massive job layoffs, redundancies, which is the only time you see office vacancy rates typically going up is when you enter into recession, you have layoffs, office space supply peaks. Or actually, is this an evolution where it is going to make work more efficient and is going to help companies with profitability? My son's just got a job as a trainee lawyer in London. Everyone talks about massive job layoffs in the legal sector. No, it's just helping the juniors. So I think it will have an impact on certain sectors of the office market. Call centers, which were the big driver of suburban business parks.
Yeah.
Well, all of a sudden, you don't need 30% of your workforce because it's dealt with bots, which are driven by AI. That will have an impact. Absolutely. Investment banking or legal services or other professional services, I think it's still an open question mark, and it's too early in the evolution of AI to say is it really going to drive a major revolution in office space. I don't think it will. I think we'll work through it and it will improve and help, but there will be pockets of certain sectors that will be hit badly.
Right. Okay. I want to take you back to real estate debt and particularly construction finance. Two of the things that we typically look for, one of them you mentioned when we look for managers in construction finance, are one, local knowledge, and secondly, the ability to take over a project if things go wrong. Because too many construction finance providers don't really know how to put on a pair of work boots and get down to a site and make sure the thing gets finished, which can be a bit of a problem. In your experience, what are the things that you've looked out for when you've been choosing a construction finance manager or a deal or someone to lead a deal?
You've hit the nail on the head. When I have built teams for complex real estate investing, I have always recruited bottom-up real estate people who know how to design, procure construction, lease, property manage, who then have an understanding of top-down finance, who have typically gone on and done an MBA in finance or a master's, who have worked for a bank. Why? Because how can you underwrite and structure complex legal and technical deals if you don't have the bricks and mortar, nuts and bolts knowledge yourself? And I get very impatient with finance guys who negotiate with me stupid budget contingencies when they know nothing about how actual hardcore real estate works. And I think it's a problem with the industry as a whole that you've got finance people negotiating real estate when they don't actually understand finance, they don't understand real estate. Right. So I think a few things. One, only go into jurisdictions with true enforceability, or really understand how you execute that enforceability. So UK's easy, no problem.
Rule of law, courts, it all happens pretty simply.
You can appoint a receiver if there's been a breach of contract, go in, no problem. Italy, bit of a problem. So what do? You have to structure security over your top co in Luxembourg, have a golden share, which means that if they're in breach down below in the SPV, you can take over the management of the actual transaction. But if you're a bank, you don't really want to do that. So, as a borrower, you've probably got a little bit more leeway than you would do otherwise. So I think, one, really understand your jurisdiction. America, UK, Australia, the European countries, particularly mainland continental Europe, have greater borrower protections, which just make it harder to lend money. I think only work with pros who understand construction finance, because you always have to assume the worst, that the borrower is going to default. Look at COVID, all those borrowers who defaulted in COVID.
Sure.
As an example, all the contractors who we thought were tier one, who went bust outside of COVID because of supply chain issues, inflation issues.
Bad contracts, fixed price deals.
Yeah, exactly. So I think really getting the right quality of finance professional with that deep understanding of construction, because you have to be able to underwrite execution risk as if you were an equity underwriter.
Right.
But of course, construction finance is very tempting because you get much higher returns. So I would say only go with top sponsors,
right.
The biggest and the best. Make sure significant equity is put up front.
What does significant equity mean? You're talking about by the construction company, by the actual developer.
By the equity sponsor. So make sure the equity sponsor is putting up at least 40%.
Right.
I would say go for a tier one contractor, but do a lot of due diligence on that contractor. Not like, because a tier one might seem tier one, but you've got to really get under the skin. He goes off to the sub-suppliers and the sub-suppliers. Talk to those suppliers. Are these tier one contractors paying you in invoice plus 30, 60 or 90 days? How are they with you? Because you'll soon start to see a pattern of whether or not that tier one contractor has got cash flow issues. And I think just be rigorous with your LTVs. There is a lot of competition. Yeah, and if a good deal passes you by, let it go. I spoke with my partner on this bridge lending business where we've got an opportunity. A sponsor is buying a building at significantly below replacement cost. He wants us to finance 80%, a huge cash surplus, but he wants to, no cash sweep. So he ends up with zero by the time we come to the end of zero equity by the end of our loan. I'm saying, no, I'll only do it if we get security over the rest of his portfolio. There's got to be skin in the game. Right. So be very rigorous. Always let a good deal buy if you're not happy. Because the last thing you want is getting into a fight with suppliers and subcontractors if your contractor goes bust.
Because time is money and your ability to operate is really going to determine whether you get your money out.
Yeah, and you think, if it goes bust, we've got guarantees. You have got bank guarantees and financial guarantees, but you try and get hold of them. They will fight you tooth and nail. Then you have to go cap in hand to the subcontractors to continue, and they see an opportunity. I had an Irish scaffolder. I built a French school in London, and I had an Irish scaffolder who didn't get paid by the contractor who went bust. It's only happened once on me. And he says, Rob, there'll be blood on the streets if I don't get paid. I had a hard Northern Irish accent.
Did he get paid, Rob?
He definitely got paid. He definitely got paid. So, so your budget goes up 20, 30% because you've got to pay off the subcontractors to keep going.
And there goes your profit.
Yeah. So stick to your guns.
Okay, very good. So, Rob, you've been an institutional manager of real estate for most of your career. When you look at teams, fund management teams, people that you want to put money with, try and work out, are they the right people? What are you looking for in that due diligence?
So I've been the GP and I've been the LP. So I've seen both sides. I've been due diligence and I've done the due diligencing. I would say it's motivation versus complacency. And you see that when you interview teams. Everybody always goes, no, 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 first-time manager, too risky. Well, that's just lazy. Look at the experience of the first-time managers. And the CalPERS, the Californian State Pension Scheme,
Yep.
they did this. I always remember that their head of investing did a whole big analysis. First-time fund managers are statistically proven to outperform all other managers. You've just got to do more due diligence to make sure you're getting the right first-time manager. And I saw it with my own team in a couple of groups where you get to your second and third fund and they just become a bit complacent. A little
too easy. Starts making a little bit too much money.
Them. Yeah. Then the other thing I would say is alignment of interest. You often, when you see GPs, the majority of the carry is going to the senior team. Well, that's greedy. What you want is a team where it's one team, one dream, sharing the love all the way through the team, from the top guy down to the analyst.
So I'm going to ask a specific question on that.
Yeah.
If you had $100 of profit for the fund manager, how would you think in a reasonable sized fund, how would you think that should be split between the top guys, let's call them the partners, and everybody else?
Okay, so typically, if you look at all the big institutions, on average, 50% goes to the house, 50% goes to the team.
Right.
Then, of that 50%, how much goes to the top guys in the team? And you've got to look at it almost like an inverted pyramid. Mm-hmm. And we used to put in place some complex ratio. So people have careers. Funds last 7 to 10 years. So, you start off with an analyst and he ends up a director by the time the fund comes to an end. And right. You have to keep him motivated as you go through his career. So maybe he starts off with half a point as an analyst. Then you want him motivated, become a senior analyst. You get a point. Senior analyst to VP. So you've got to keep these ratios in place mm-hmm. as you build out your team. So I'm not avoiding your answer. I'm not avoiding giving you an exact answer of percentages, but I would say, again, it depends how big your team is. I had 30 people at EQT. I had 10 people at Wainbridge. I had hundreds of people at Credit Suisse. I would say, I'm not going to give you an exact percentage because each one was different, but you've got to just make sure from an HR perspective, you've got your career progression, you've got carry left over for new recruits.
So it's not only the amount going downstream to the more junior people, but it's also the growth in those junior people's percentage as they progress within the firm, so that they're motivated to stick around.
Correct.
And to succeed and to work really hard.
And you've got to keep carry back for new recruits as you grow your business, grow your team. So it's very complex, and we would spend hours and hours on it. And then the other big issue is 1 for alignment and 2 for tax. Mm-hmm. I want that my guys, and I use guys in the gender neutral sense, have skin in the game. I don't want them to have free carry. If you're an entrepreneur and you're underwriting entrepreneurial risk, put your own money in the game. There's no free lunch in life.
Yep.
And a lot of the times I'd be recruiting from the big shops where they did have carry for free. And it was a different mentality. I was looking for guys who really underwrote as if it was their money, and it was. I want you to mortgage your house a bit extra. I want you to not buy the second home because you've made a good bonus. Put it in the fund. Mm-hmm. And that way you really see who are the proper entrepreneurs, taking a risk-adjusted return, and who are the guys who want a bonus and a bit of a free carry.
Good. Excellent. All right.
It's interesting. And then I think the only other point is culture. Mm. You've got to make sure, what we call it, excuse my French, a no arseholes policy. You leave your ego at the door, you do what's right for the business. And that's very difficult to find because ultimately in private equity and high powered finance, you're dealing with overachievers who have been in an entitled academic and financial career environment where they're constantly striving for success. And in a world where that drive tramples on people, so trying to get that balance of overachievers, no egos, humility, don't point fingers, we're in this together, is difficult. Team composition and culture for me is what I really look for when underwriting a GP.
Very good. All right, well, that was a fantastic overview and some good pointers. And I really appreciate you joining the podcast and sharing 30 years or more than 30 years of real estate wisdom.
Well, my pleasure. I always love talking about real estate. I've been doing it long enough now. My kids are bored, but I always enjoy it.
Well, we enjoy it as well. All right. Thank you very much, Rob Rackind. And I will note that Rob's daughter is getting married, so we'll wish him a mazel tov as well.
Thank you very much.
And we look forward to bringing you more episodes in the coming weeks and months. So stay tuned, and thanks everybody for listening.